This talk is basically about what we thought about last year, how the markets performed, commodities, ETFs, and our own portfolio, and basically looking into the future, what we're buying, what we're avoiding, no names, and our summary conclusions and our top picks for 2018, which thankfully 3 of these guys just happen to be in that list. Okay, so the big theme that we had coming from last year, 3 great forces rule the world: stupidity, fear, and greed. Okay, so said the last Jedi. So what was 2017? So what we noticed was there was this big risk-off mentality, and this is the VIX, the volatility index for the CBOE volatility index. And it got pretty low and flatlined almost. And so we had a very risk-off mentality in the markets in the last quarter of 2017. And so we could see that in the greed to fear index that CNN Money puts out. There's about 5 different things it looks at and melds it together and then creates this, this clock about greed and fear. So the lows were getting higher into the latter part of 2017, getting to about 80, but we were reaching extreme greed levels. And so how did that translate into the performance of the markets? So what we saw was basically, yeah, you get some great returns from, let's say, the lithium ETF, which is that one there. The XBM, which is a base metal ETF listed in Canada. You've got the uranium ETF there. You've got the S&P Junior Index, and you've got the GDXJ. So you've got here several ETFs that follow different commodities. But you could see right here with the Dow Jones and the market by itself is giving you a 25% return. So, you know, why bother? You know, I don't need to know all of this other stuff. I could just buy the market and I'll get 25%. So a lot of that took away from some sectors, especially, I believe, the gold sector. And so what did that translate into individual performances? So obviously you've got this Bitcoin thing that, you know, eclipsed everything. 1,400% return for a year. I mean, it's fallen back 20%, but still, you know, it's done well. And then you could see individual commodities doing well here, but the ETFs and a lot of these ones didn't do as well as the commodity. And then if we look at the Bitcoin-esque returns of the junior mining sector. So this is a graphic I've shown before, and I've just updated it for the entire year. So these are, I think, 15, 16 companies that we tracked. Some of them we owned. And so what I did was I took a price before a certain news item came out that sprung the stock out. And so I did this price to peak. And so the average of the price to peak, like before when I started this, you know, things like Camino, COR was the highest. And then every news story was higher. Orion, GTT, and then the Novo came out, and that was the highest. That was 1,000. But who cares about 1,000 when you can make 4,500? So the stories got wilder and wilder, and the returns got ridiculous. And you know, average returns of 660% for these companies in less than 3 months. So even better than Bitcoin. So, but the issue is that this is a risky market, as is Bitcoin. Most of these stocks have on average given back about half in about 6 months. Some of them more. So what we find is that there was a sort of fatal attraction in 2017. And we talked about the twilight zone last year, that we thought that we might be approaching that. For our own subscribers, we find it difficult to purchase some of these juniors. When we get asked about it from our subscribers, we'll go to their websites, we'll find they're poorly organized. We'll find their presentations flawed. We'll find the documentation lacking. We'll find the disclosures very selective. And such that for us, if we bought it, we would have to disclose all the problems that we have with it, and our better subscribers would say, well, why are you recommending we buy it? Well, I'm actually not. I think this is a flip. Flips are hard for people that are not watching the market every day, and we don't want to put our subs in that position. So the speculation was right, led by promoters, chat rooms were going nuts, and so retail investors flocked to these juniors with an almost total disregard for hard data like geology, which is still important, and also assays, which can be helpful. So what we're hoping in 2018 is really that science comes back and that there's a look at these juniors and any kind of company in the mining sector with a degree of trying integrity, I guess, to make sure that the geology works, to make sure they've done enough work on the met if they tell you something, to make sure that the resource makes sense. But some of these guys haven't even got there. They don't even have assays. So it's really hard to dispute or be critical about something with very little information. So those are a lot of plays that we've avoided in 2017. But they've still done well. So higher risk requires homework. And a lot of people don't like homework. So what we do in our letter is basically help our subscribers do their homework for them and save their pets some indigestion. So in 2017, we were quite active. We closed 18 positions for average return of about 80%. And a lot of the double sells have been averaged. And this was over the entire year. Some of these stocks were bought, obviously, beforehand. And now I'm going to go over what worked and what didn't work in this portfolio of closed positions. So what definitely worked was a discovery. Discoveries help. Oh my God, do they help. So we had Ivanhoe. I bought it for different reasons. I bought it because I thought it was undervalued just the way it was. It had 3 assets. It had Kamoa that was coming up. It had all this cash. It had a spectacular promoter in Robert Friedland. And I thought, just right now, it's undervalued by about 40%. Just that. And so my downside's protected. But then they find Kakula. And we make 800% on it. You know, and that's not something I put into the equation. But that's why that thing did ridiculously well. And also underlying it, you got a positive commodity market in copper. But but this was in the DRC. You know, this was not in a favorable jurisdiction. But the value of finding something can offset that. And the other one, Mariana Resources with Hot Maden, another discovery. And they only own 30% of it. But the geopolitical risk of that project was mitigated by their partner who was linked to the president. So even in the coup, I told people to buy. And they did very well. Because that asset is 1 in a million. So that's what worked. And so you can see it basically just in a section for Hot Maden. This was before, so they showed this intersection and they got 70 meters of 63 grams with about 2.7% copper. Crazy. But it wasn't drilled down the neck of anything. And when we saw it in the field, this was really chunky, looked great. And it assayed, but we waited for the assay. And then they drilled this other hole, assays pending. We didn't know what it was going to be there, but that continuity looked great. And what did they come up with? They came up with another 30 meters of 17 grams. And we saw that consistently along strike, down depth, and we thought, well, this is an incredible deposit. This is going to work. So we had it, we sold it during the PEA, and did well. But the key here was discovery. Again, geopolitically, it's in Turkey, right during a time of a coup. So yes, geopolitical risk matters, but when you're into a discovery and you find something that will live through generations of cycles, it'll surpass the geopolitical risk. Somebody will build it. Okay, what didn't work? Because there were some reds there. So what didn't work was I went to Mongolia. We saw some really nice drilling results from Erdene. They had big land package, southwest Mongolia. We were kind of worried about Mongolia, but they started drilling undercover and started hitting that. And so we were very interested. Made arrangements to go and site visit at PDAC, went to it. Liked the team, but when geologically I thought, well, Jesus, this mineralization is very high grade in little small intervals. We're going to wait for more drilling to see if the continuity is there. So I bought a little bit. I didn't buy a lot. I didn't go full tilt. And I'll show you a little bit more about that. Okay, and then Amani, DRC again. Guys found a deposit in the DRC, know the DRC, are really close to Randgold's Kabali deposit. But there you need more than 2 grams to be viable. And all the drilling results weren't giving them 2 grams. And in the same instant with Erdene, like, I'm thinking I want 2 grams for where you are in Mongolia, and you're going to need at least 1.5 to 2 million ounces for anybody to come in to buy you, because I don't want you to build it. I want somebody else to come into Mongolia and buy it, but it's got to be an exceptional deposit. If you give me a marginal deposit in southwest Mongolia, nobody's going to come. So it's just like Wayne's World, build it and they will come. But now you got to find it and they will come. Here we didn't get it. So with Erdene, they drilled a lot of holes, an amazing amount of holes, very densely spaced holes, but I didn't see that in their section. And so we did our own resource calc, plotted all the results, and then we were having trouble plotting these reds and magentas, which really is what would work. So when you saw the hot modern, you saw the continuity, you saw how they were hitting high grade and it kept going. We couldn't find that here. So we sold it. So what are we doing in 2018? So again, we keep coming back to this theme, and it's the same theme we've had for 18 months. We don't really change. So again, producers are being forced by their investors, thankfully, to generate returns, and that requires high margin projects, and they're finding that they don't have a lot of them. And now that they've decimated their exploration, they don't have a pipeline. We'll see that with the prospect generators and the explorers, okay? Because this is really where you want to be. It's high risk, but the point is that this is what needs to happen. These discoveries need to be happening, and the majors are not investing in it. And so they're coming down and investing in the juniors that they know can do it. Because technically what you'll find is they don't have the expertise anymore because they've left. And now these people are running juniors. So if you want to take some clips, mining-friendly jurisdictions, and I don't mean geopolitically has got to be AAA. I just mean that they're okay with mining. That's it. You could have a AAA country that's not okay with mining. That's not a country you want to be in. Okay, you want competent management teams, and what does that mean? Not only understanding geology, jurisdiction they got to understand, and they've got to understand capital markets. This will drive probability into a higher success in a very highly risked sector. And so gold really did have a good year last year. Like for what Bitcoin did and all this talk about you know, gold not being a safe haven asset and all this other stuff, it didn't do badly. You know, and it actually gave you a better return than the year before. So we're back to about 2010, 2011 year-on-year returns, which is good. But where we're focused is on early stage. We do have a few producers, but they tend to be the low-cost type to mitigate our risk. But really, since 2003, not the absolute grassroots exploration expenditures, but the proportion of grassroots in terms of your entire budget of exploration has been declining since 2003. So that's a secular trend that the industry's been eating. So you shouldn't be surprised when people are not finding high-quality projects, because a lot of what they're finding are brownfields projects. They're not finding, they're expanding more low-grade into their plant and just keeping it going because the plant is running and we got to keep it going. But to really find one of these high margin deposits, you're going to have to think out of the box, and then you're going to have to get out of your truck. These guys don't have people to get out of their trucks anymore. And copper, we like copper as well. So I work for Phelps Dodge, so I'm a bit of a copper junkie. But you know, we're looking at copper mine production, and there's just not a lot of big projects coming along. And copper is not only, you know, related to its own demand cycle, but now the battery demand is starting to pull on copper, which is a good thing. Zinc, we still like zinc. You know, right now, if anybody knows about treatment charges and refining charges, TCRCs, right now when they're telling you they're dropping, that's good for the zinc market, because what it's telling you is that there's not enough concentrate out there. Nobody's producing concentrate. So the smelters, they charge the mining companies a treatment charge to take their concentrate. If the price is low, that means that they're just not getting concentrates. When I worked at Phelps Dodge back in 2004, 2005, when copper was really tight, the TCRCs were negative. They would pay you to give you the con. So we're not quite there, but the market's tight. And the other thing is that the Chinese inventories are declining. So that's what other people are holding, not the visible exchanges. Stocks declining. So here's the actual stocks going down, which is good. So those stocks are in cathode. And so that's why you're seeing the premiums to cathode spiking up, because nobody can find any zinc cathode. So that says a very tight market right now. Okay, and then the other one's lithium. We've probably all seen this graphic. I mean, God knows when this is going to happen, but it's really about, like, one side of the demand story. Why I like lithium is not only the demand side, because people will say, well, there's lots of lithium. You know, I think I got some in my backyard. You know, there's not an issue with lithium, but the problem is that the ability to actually produce lithium quality, battery quality lithium is very small, because the market's very small. So the technical people that can actually do this is limited. So if you're going to do this, the probability that that lithium company that you've got actually knows what it's doing is small. So you really got to know who that management team is and who's involved in it. And they've got to have a connection to some kind of producer or somebody who knows what they're doing. Because especially in brines, you know, to actually translate that brine, which has got lithium into it, put it on this pond, evaporate it, get the kind of evaporation rates you need to feed the plant, and that's a lab experiment in itself to make sure you can control the magnesium, the carbonation, and produce a battery quality product. Because if you don't produce the battery quality product, you take a discount on the price. And that's what Orocobre got. Now Orocobre is producing better product, more volume, and making lots more money. Okay, so here what I'm trying to show is that this is what we thought. This is what we got. I mean, sorry, this is what we thought, this is what we got. And so we had a 66%, only 2/3 of the planned capacity actually happened. And we see that continuously in this market. And the biggest constraint is human. We do not have enough people that know what they're doing in this. Because we're trying to increase a market that's the size of a mid-tier gold producer's revenue into 1/3 to 1/2 of the entire revenue of a gold production over a year. It's a big change. And a lot of these guys, especially, you know, grew up, especially the hard rock guys, grew up in South Carolina, and a lot of those deposits don't exist anymore. You know, but that's where a lot of the expertise is, not only in hard rock, but also in brine. Okay, so what we're not buying. Okay, so I see some uranium people here. So we're not buying uranium producers. Okay, why? Because I did this piece on inventories, the overhang, and I'm still not convinced it's going to go away anytime soon. So I'm not going to buy a uranium play that's producing uranium, because they'll need money and they'll constantly need money. So if you do like uranium, I'd suggest go with explorers. Leverage gold plays. Okay, here's the big issue here. You know, we know that there's been an 8% compound annual growth rate decline over the last 5 years in reserves. Those reserves don't disappear. They're still there. So you've taken about 200 million ounces of reserves out of the market, but they're still there. So when the market comes back, those reserves will come back. So when you buy a leveraged product, an equity, they got to compete against these ounces, because if I'm a producer and I've got my own 10 million ounce gold that works at 1,500, I'm going to use that first before I buy you. Cobalt, controversial, but when I was with Phelps Dodge, moly was another market I used to deal with, and we controlled a lot of the moly market. And I could not see the point of anybody actually starting up a primary moly mine, of what we could do with that. And then also, when I was there, we bought Tenke. And part of my job was to see how much cobalt we could put onto the market without killing it. I understand that the cobalt market's improving. The other demand side issue I have with it, whether it's right or not, is that the changes in battery technology, what I saw in this UBS report, could impact cobalt demand. Okay, so those two things on the demand and the supply side, that's what makes me sort of stay away from cobalt. If you like cobalt, I've seen some streamers doing cobalt. That might be something of interest. But for me, with a primary cobalt, I'm not overly keen. In terms of battery metal exposure, right now we're more keen on lithium and copper. So our current portfolio of open positions, no names except for the ones here, and Tinka, which we also published, that was one of our top picks. We're sitting at about 51% in terms of our open positions. And year to date, those positions have given us about an 11% return, ranging from down 11 up to 46%. And so, as you can see, some of the top performers here, Mirasol, that was a position that's been there for a while. We've got two positions, one that's 2 years old, that's doubled, and another one that's 5 years old, that's up 830%. And then a couple of years, I think it was 2 years or 3 years, was this Evrim position that's up 265. So these are all prospect generators. You know, but if you pick the right team, they're constantly finding assets and basically a product that people want, which are the big companies, they'll find people. They'll fund themselves. And eventually they'll get a deposit, they'll cash out, and do it all over again. And that's what we're looking for with the prospect generators. These are long, long-term holds. Tinka is more of a zinc explorer, again, discovery. And the next significant catalyst is the PEA. They're not here, but they'll be at Roundup in Cambridge. And the other one, that'll be the first speaker up here, will be Advantage Lithium. And what we liked about that was basically the lithium exposure, competitive tension between two producers, which I'll let David talk about. So I'm running out of time, but right now we've got 25 positions, 16 companies, predominantly prospect generators and explorers. Only one developer and 2 cash flowing companies. Gold, zinc, copper, and lithium are where we're focused, but again, this could change. Summary conclusions, basically what I just told you 20 minutes ago. And top picks are these guys, 3 of the 4. Okay, so I will start off with